Alrighty. Hey everybody, welcome to today's webinar. Let me share my screen with you guys. We're excited to have you guys join us again today for today's webinar. As a reminder, we're going to be talking about the 2025 tax bill breakdown for dental practice owners and 1099 associates. Now, I'm sure as you guys know, that's a pretty big bill. We're going to specifically talk about the impact that it has on, dental practice owners, right, and 1099 associates. So, specifically for dental practices and how that impacts you guys. Now, before we go into the agenda and what we'll talk about today, I want to just do a quick brief introduction between me and Omar. To kind of introduce Omar, Omar is the CEO and founder of Virgin Consulting. So some background information on Omar. He launched his first business at 16, founded Virgin Consulting in 2013. He had various roles at Fortune 500 companies before that. He's an active real estate investor, and he's part of the Goldman Sachs, 10,000 small businesses, and we're also Inc. 5,000 honoree in 2024. So quite a big background and experience from Omar. Myself, your host, I'm the partner here at Virgin Consulting for advisor services. I specialize in tax strategy for dental practices. I lead our tax planning for large dental operations. I mean, that ranges anywhere from 1099s to franchise builders. And hundreds of dentists have grown tax efficiently with our advisory over the past 6 years. Now, before we go into everything, I just want to kind of give you guys an agenda of what to expect today. As I mentioned earlier, we're going to be specifically talking about the bill and how it impacts from the dental industry. So the first thing we're going to talk about is kind of what's changing in 2025. We'll then go into buying a practice, big deductions that you might be missing. Then we'll go into startups, how to maximize your year one write-offs, buying your building, hidden real estate benefits. We'll kind of segue into existing owners and how you can stack strategies for big wins. And then we'll talk about some real case studies. Before and after tax planning, we'll talk about where you might be in the different scenarios, whether you're buying an existing, a startup, etc. So we'll talk about some real case studies. And then at the end, we'll have a live Q&A. So we'll ask you guys for your questions, and we'll have a dedicated section for that. But got some exciting stuff to talk about today, and wanted to overview that before we kind of jump in.
Awesome. Thanks, Hamza.
Cool. And so to kind of first, start off, I wanted to talk about just do a high level summary of some of the major tax law changes. So the first major tax law change was bonus depreciation, right? So it is now 100% going forward, which is massive, which is big. It was currently at 40%, it was phasing out. And so what was kind of a deduction that might have not been as powerful is now back to 100%, which is an absolute game changer. Section 198, the QBI deduction, right? That has now been made permanent. So, for a lot of clients, we were talking about that this was phasing out and we wanted to maximize getting this deduction. Well, now it's made permanent, which is even more amazing. The SALT cap was increased from 10,000 to 40,000. So just giving us the ability to get bigger deductions, right? For our individuals that applies to. Domestic R&D expenses are now deducted as incurred. So that's, again, another additional benefit. And then entity structuring, right? So now this is going to be more scrutiny on the S Corp owner comps. So, for our clients, obviously, we help you out with that. And, but there's going to be more scrutiny on that. And that's going to be a very important thing that we'll have to, focus on going forward.
And so the tax bill obviously has a lot of stuff. We kind of squeeze a lemon and just wanted to get the key points that really will impact dental practices. Everyone's heard about the bonus depreciation, how it's that's one of the biggest drivers for expansion of offices, of office purchases, of going into multi-unit offices. QBI has always been a bonus, it's been like a free deduction, we like to call it, if you qualify. So there's always been games around how do we game the income to get to a point where you can qualify for QBI and get that free deduction. It's like getting like a $40,000 tax deduction for free. The saw cap, this is, really relative a lot to those doctors that are in states where you have high taxes, high state taxes, and those before would not be able to be captured through itemized deduction. Through a lot of back and forth negotiation, now the cap's at 40,000. So is it perfect? No. But the delta of being able to deduct 130 grand if you're in a state where there's state income tax allows for some savings. The R&D expensing, this was amortized. This was amortized if you, for the past few years for R&D expenses. If it's domestic, that was a silly rule anyways. And thankfully they kind of brought it back to where you can deduct it as incurred. This really only correlates to very specific dental practices that really do qualify for R&D versus a lot of the um, kind of marketing that's around the fact that every practice qualifies for R&D, which I would say is probably 95% of practices won't qualify for the credit side of R&D. And the entity structuring. And this has been going on for the last few years, and now there's a lot more emphasis, as we all know, the IRS is broke, and so the S if you're an S corporation and the salary that you pay yourself is going to be under a lot more scrutiny because it's an easier win for the IRS, for them to be able to get that money, and there's a much more higher penalties because um, you're not just impacting income tax, but impacting Social Security Medicare taxes. So whenever you are impacting Social Security Medicare taxes, the IRS gets a lot more serious about its enforcement. And so this is an area where this is not a change in tax law. I want to be clear about that. This is more a change in the attitude of the IRS that we have seen, and the funding that they have received in order to go after S corporations a lot more. So, we have a lot of doctors that, do consultations with us and so forth. And they're current and they're a practice owner and they're earning 30, 40K, 50K salary. I mean, that's just asking for audit. We actually just had a call with the client who's buying an office. And we're going through the returns and the financials and everything. And the office produces $700,000 as he's the only doctor, and the compensation to himself is zero. Everything was coming out of the dividend. That's basically really bad planning and really bad uh, consulting on a salary, because IRS can come back and say, you're a doctor. I'm gonna say the fact for the last 5 years you should have paid yourself at least 120 grand a year, and so now you owe us, you know, social security taxes of 15% on 100K, which is 15 grand times 5 years. That's 70 some odd thousand dollars plus the penalties and interest. So now all of a sudden you got $100,000 tax bill that you're hit with, and this was real. Like this just happened last week with a practice they're buying. And when you are messing with Social Security Medicare taxes, there is no, there's no leeway. The IRS is no leeway on that because the Social Security Medicare system's already broke. So they're not, there's no appealing it. There's no nothing. You're pretty much on the hook for that, and they will put they will seize your property and your time and your practice for that. I'll let you go on to the next slide, Hamza.
Yeah, yeah. Very good insight. Moving on to kind of who this impacts. So this impacts, 1099 dentists and specialists, buyers of practices, so like acquisitions, startup practices, real estate owners, doctors who are trying to buy their own buildings, and then, existing practice owners looking to reduce their tax. All of these individuals, this tax law, these bills that Omar just kind of discussed, this impacts these people.
Yeah.
Now, go ahead.
No, go ahead.
Yeah. Now, going into kind of the wins from this tax bill and kind of giving a little bit more explanation, right? So the win number one that I talked about was bonus depreciation, and that being 100% now, whereas last year was 60%, this year before the bill was 40%. It's very valuable because when you buy a practice, you gotta you have a asset allocation, right? So a portion goes to goodwill, and then a portion goes to your fixed assets, right? Your equipment, improvements, etc. And so with the bonus depreciation, we now can do 100% of that. And so any of the assets that have, less than 20-year life, so again, like the equipment, construction, these type of things, leasehold improvements, furniture, et cetera, we're able to do bonus depreciation and take 100% of that deduction. And this could be the difference from, having a profit to being, maybe at a loss, and therefore using that to offset some other income. And so that's the first one, because without this tax change, we'd be getting 40% of that number. So for example, you had $100,000 deduction. This year, before the bill, you'd be getting, $40,000 deduction, but now we're able to get that full 100,000.
And so if we explain this, when you're buying a practice, and for those of you guys who haven't bought a practice, think of it as if you're going to Costco and you get a receipt, right? What stuff are you putting in your cart? So if you're when you buy a practice, let's say for $1 million, on the agreement, you'll see the fact that there's an asset allocation. Now, if you aren't advised properly, then the seller is going to basically stick everything into goodwill and patient records, and you get very little deduction on that, right? But if you on your side are advised properly and you do some negotiation and so forth, and then really what you get is a receipt that basically says, okay, I bought a practice for $1 million. Of that $1 million, this much is the equipment. This much is a leasehold improvement. This much is a supplies inventory. This much is patient records. This much is the goodwill. This much is a non-compete. And then basically it's kind of like pretty much like a receipt, right? And it's itemized. And so how was happening this year prior to this bill being signed was the fact that if I bought a practice, then all the stuff that's 20 years life or lower, which is the simplest way to think of it is things that you can touch and feel, right? I can touch and feel the walls, I can touch and feel the equipment, I can touch and feel the supplies, I can touch and feel the CB to CT, right? All that stuff, right? So anything you can touch and feel, you are only going to be able to deduct 40% of that in the first year. Now with this new law, you can deduct 100% of that. So all of a sudden, practices become a lot more attractive, especially in this environment where build out costs are so expensive now, and the real estate and then to build out a practice is so expensive. This tax deduction really helps ease that practice purchase price. So now, like we were talking to a client this week when they're looking to buy, they got a pretty good deal on an office, and they're looking to close this month, and one of the questions that came up and like, okay, well, Omar, is this, I still feel like I'm paying a little bit more than I should. And my thought process was, look, we gotta look at the whole economics of it, right? If you're gonna go build the same office, it's gonna cost you a lot more plus the patients. So here's where you start playing with the depreciation. Here's where the bonus depreciation becomes a asset for you and say, okay, I'm paying a little bit more for the office, but if I'm able to get a $400,000 write-off, right? Then really out of pocket I'm X, right? And so this is a big win, but in an environment where buying practices already very competitive, this will make buying a practice even more competitive, because those people that are able to get good asset allocation structures are going to save tremendously, and they're going to use the money they save in taxes to finance the growth of that office to turn it around.
Absolutely. And kind of moving on to a case study to kind of talk about this exact scenario, right? Kind of before and after tax planning, buying, as kind of Omar mentioned, buying a practice. In this kind of case study, the doctor bought a practice, $1 million, without planning, getting about a 50K write-off in year one. Not really a needle mover, but with asset allocation and then now using this bonus depreciation that we just talked about, we can get 400K plus in first year deductions, and that's 100K of tax savings, if not more, depending on the amount. And of course, you can see that that's a complete game changer, and the impact it can have on your tax by having the right structure, strategy, and now maximizing these new tax laws.
And you can also play with that. Now that's where strategy comes in. And that's really why you would be working with the dental CPA that are a strategist, right? Because if we're buying this office, we're also looking at the fact that, okay, what did you earn this year as a 1099 or a W-2 before you bought the office, right? And we would sometimes take part of the equipment and do a bonus on it. Part of it would maybe sometimes do 179, right? And so what that allows us to do is sometimes carry over that deduction to the next year. Let's just say you don't need all the deductions this year, right? Let's say we don't need all of it this year. And so if sometimes you do the math, sometimes taking a big deduction and spreading it over 2 years, where income is X in year number one, but Y in year number two, yields to a better savings than taking all of it in 1 year. And so that's where you start basically interchanging strategies between 179 and bonus and start really playing with that. And then combine that with 199A and say, okay, let's just say I would never qualify for 199A in year number two. I'm going to qualify year number one. My income is lower. I'm never going to qualify year number two. So that's where then you start playing with it and say, okay, well, if I take part of it now and part of it next year, not only will I get lower taxes overall, but now I qualify for this new. Remember, I called it the free tax deduction, the 198 free tax deduction, which I wouldn't qualify for in year number two because I'm making too much money. But now I got that too. So now you basically it's like you're playing Jenga and you're stacking them dominoes on top of one on top of another. And so that's the power of planning. So it's not just basically planning is just okay, take everything and dump it and just write it off. Planning is looking at a multi-year profile and say, okay, how do we move the needle across multiple years, and get the most juice out of this acquisition.
Absolutely. Um, Now kind of transitioning to talk about, starting a dental practice, so kind of a startup, right? So key deductions for startups. A couple things you can do, with the equipment and the leasehold improvements, right, from your build out, applying bonus depreciation there. Again, with it being 100% bonus depreciation, us being able to take a big deduction in year one. A lot of our clients that we deal with, they've had existing companies because they were 1099 independent contractors. And so using those favorability rules and having a SEP IRA in the first year and only having to contribute to themselves and getting a nice deduction there, using basically the fact that they have all these bonus depreciation, right, with tax savings and using that money to then fund a SEP IRA, right, and turbocharge their tax planning. Of course, as a startup, you have a lot of pre-opening costs, right? Whether that's legal, consulting, marketing, all this can be amortized, and so we'll be getting a deduction, right, for those pre-opening costs that you might have. And then the important one that Omar touched on a little bit earlier, right? Considering electing S corp, right, and that's to avoid capital gains on future conversions. Obviously, S corps have the benefit of the self-employment tax side of things, but it's getting in the right structure at the right timing, as Omar had mentioned earlier, and with his example. And so these are some key deductions for startups.
And here's also where planning comes in because we've had doctors who didn't elect S corporation the first year, and they came in the second year, and now they're getting hit with self-employment taxes. Here's a problem: they took a lot of deductions in the first year, and so now when we flip them from an S corporation, from a non-S to a S, right, in the second year of the startup, the equity is out of balance. What do I mean by that? The fact that, let's just say cash in the bank is 50 grand, your loan to Bank of America or Provide or whatever, right? Huntington is $600,000. So just simple math, I'm upside down. I'm upside down by $500,000. IRS rules are the fact that if you convert an S corporation when you're out of balance, all of that is considered capital gains. So think about this. A simple wrong timing of an S corporation can hit you with the $400,000 capital gains, right? You know, and most people don't even know that they're doing it, right? So it's really important to consider timing of it. So what we typically will do is the fact that we will wait until the December of the year of the startup to really make a decision, unless the startup is doing really well, and then we'll then basically say, okay, we're going to flip it at this point in time. This is how much money you can take out. This is how much money you got to keep in, to make sure you don't get hit with a double tax, right? And so that's kind of how to navigate that aspect of it. That again requires really sit down and planning and thinking it through. Sometimes you're in a bad area and it sucks, but you're not going to make a profit for a couple of years. Then the S corporation may not be the best structure at that point in time, but sometimes you're profitable from year one. But then if you're going to elect in year number two, then now you're going to hit with capital gains tax. It's a tax that people don't know about, because most people don't dive into it. Most people that are just preparing a return would just do the return until you get audited or something gets triggered on the IRS side, and then they're like, wait a minute, you had negative equity when you signed this S corporation election, right? The other thing to think about is, if you have multiple locations, how do you plan your startups, and how do you plan the write-offs and the losses from the startups? That's also where entity structuring comes in. Because if you already plan, and if you were a previous webinar, we talked about goal setting. If you're already planning the fact that I know, okay, in the next 3 years, I'm going to open 2 locations or 3 locations, then you want to do the spillover effect, right? So you're going to use losses from location 1 to not pay taxes for location 2, and et cetera, et cetera. Then, you need to look at, a non-S corporation structure. And that could even be being more sophisticated as in having a partnership with yourself. What I mean by that is, having yourself and having another company that you own. Those two entities then create a partnership between yourself, and therefore now you use partnership rules, and that allows you to deduct stuff without having an equity issue because you're a guarantor on the loan. So it's getting a little more complex, but what my point behind all this is to understand that there's so many different wheels that can be turning depending on what your goals are.
Absolutely. Now going into another case study, and this is now kind of talking about buying the real estate, right? So in this example, we're just kind of talking about the difference between buying and leasing, right? And specifically buying. In this example, we have a building cost 750K. Now, normally this would depreciate in a much longer, period of time. And so the strategy that a lot of our clients are familiar with is what's called a cost segregation study, right? And so, you're getting an engineer report, and to kind of simplify what this is without confusing you guys, it's kind of getting a long report that basically, instead of your asset being depreciated at 39 years, is breaking down things that are, 5, 10, 15 years. And what is the relevance of those years and those depreciable lives is that they qualify for bonus depreciation. And so what was much slower depreciation is now much quicker. And now combining that with the fact that bonus depreciation is 100%, we're able to get, almost 200,000, a little bit over 200,000 in first year bonus depreciation on that building purchase of 750. And the net impact on taxes in year one is 75K plus, right? Depending on the building costs and whatnot and the final numbers. But it's obviously a very massive swing on your tax bill. And you can get north of 75K in tax savings, in this example.
Yeah. So and this is also like, thinking that the real estate strategy here can also be used if you're buying a practice too, and so that this is where you really want to do an analysis and say, okay, what am I going to save if I buy versus lease? Leasing sometimes will get you the perfect location, right? Buying allows you to if you're able to get your ideal location, you're looking to buy, take those tax savings, reinvest that in the practice, to boost the practice up, and then eventually, maybe you're going to sell the practice, but you keep the real estate, right? And so, but cost segregation study is typically for practices that you are 100% the one occupying the real estate. Oh, excuse me.
Now, very important thing that we wanted to talk about is kind of what we call stacking, right? And so we just talked about kind of different tax deductions and specifically related to kind of real estate and whatnot. But what takes tax planning to the next level is stacking deductions together, right? To get you into a different tax bracket, to get you qualified for QBI deduction. And so that is what gets you the maximum impact. And so kind of give you some examples of, of what we could do for an existing tax or existing dental practice owner is stacking a bunch of couple things together. So for example, doing bonus depreciation. So that doesn't necessarily mean you bought a practice or, it could be that you upgraded some equipment and you've got equipment deductions. And so we've applied bonus depreciation on those. You set up a 401k plan and you're maxing out from the employee side and you got your employer match. Now, if you're a high net income earner, adding on top of that 401k plan, a cash balance plan, so you could, you can, get north of 100K in your retirement contribution. So obviously you're doing a big contribution, big tax deduction. We've talked about entity optimization, so being an S corp and having that reasonable salary, so that we're mitigating that self-employment tax, as we discussed earlier. But all these deductions combined is lowering your income, so now you qualify for the QBI deduction, which then gets you another deduction on top of that, right? And so stacking these together to get multiple tax savings, and a bigger tax savings, if you will.
Yeah, and stacking is really where strategy comes in, and one of our key goals typically we're doing using the stacking strategies. We're trying to get to the QBI because that's a free deduction, right? And so you're playing with numbers to say, okay, well, if we do this and this and this, then we'll fall into the income threshold where now we qualify for QBI, which then drops your income even more. And so that's the kind of the science behind the stacking strategy.
And kind of showing a case study with this, stacking that we're talking about. So, using a existing practice that is making 800K net income, without planning, they're going to have a 300K plus tax bill. And so, what we kind of outlined here is a combination of strategies, right? A stacking plan, if you will, where, they've done a 100K cash balance plan, right? They're doing a 401K plan. So we put 30,000, you're maxing out from the employee side, you got your employer match. So you're combining the 401K plan with the cash balance plan. Um, they bought equipment or, did some renovations. So we got 50K in depreciation through bonus depreciation. And the combination of these two things have now unlocked QBI, which got them another 60K deduction. And so after stacking all these things together, their new tax bill is about 150K. So we essentially, through combining all of these deductions, unlocking the QBI, we've now cut your tax bill in half, and that's obviously significant.
Then, and again, also the strategy depends on your goal, which is I go back to our previous webinar. We talked about goal setting. If your goal is to, slowly build up a real estate portfolio to have passive income, then you're going to focus a lot on the strategies for real estate, right? If your goal is the fact that, okay, real estate isn't my cup of tea because yeah, it's not as glamorous as it really sounds because you are picking up the phone at midnight if the toilet is overflowing, right? And it always happens at the most perfect time. You could be on vacation somewhere else, and then you have to deal with that, right? And so then maybe investing in 4Ks, cash balance plan, investing in equities, which will grow with time and dividends is a better strategy. So then you become more 4K, more cash balance heavy, right? And less real estate, buying your own building, Airbnb, etc. Strategy. It really depends on it, and depends on what your goals are, and that's how a perfect plan can be crafted for you specifically.
Absolutely. Now, I wanted to do a quick recap by the audience type. And basically how we can get the same, 60K to 100K in tax savings, but even if you're a different, uh, individual, right? So if you're someone who's a buyer, things that we could do, like I said, the bonus depreciation on your asset allocation, the entity structuring with the S corp, right, and having proper salary, doing a SEP IRA because of having that existing company already and using those favorable rules, and then between those three, getting the QBI deduction. So estimated tax savings in that first year would be that 60 to 100K as I was mentioning. Even if you're a startup, so you're not buying, you're starting up a practice. You can do the bonus on the build out, on the equipment, the construction, right? Get a nice deduction there. Again, entity structuring, whether you're an S corp or partnership, both have their benefits. And then, analyzing the associate income, right? And so again, another way where while your situation might be a little bit different, we're still capitalizing on that 60K to 100K tax savings. And then the last group of category would be you're an existing owner. So you might buy equipment, you might do some improvements, some renovations. We can use that bonus depreciation to get a nice deduction. Um, you might set up a defined benefit plan, right? Like that cash balance plan, where we can do 80, 90, 100K into a retirement plan, right? And get a large deduction, top that off with your obviously a 401K. So combining those things, doing the accountable plan for reimbursements, and then either purchasing a building, maybe where your office is located at, or moving somewhere, or a short-term rental, right? With again using these bonus depreciation with the cost segregation reports, and getting those deductions. So regardless whether you're a buyer, a buying practice, you're starting up a brand new practice, or you might be an existing practice owner open for 3, 4 years, there's things that you can do with this new tax bill that will get you that 60 to 100K in tax savings.
And you can notice the fact that that someone that's as an existing practice, we're focusing less on, big bonus depreciation numbers, but the assumption is the fact that you're cash flowing well, so then you're using more retirement defined benefit plan, those kind of strategies to grow your to grow not just your retirement, but reduce your taxes. And then you have the option of looking at short-term rentals for a building or Airbnb to get into real estate. When you're a buyer or a startup, then technically you should have a large amount of deduction on the front end, and technically your income is lower on the back end, and so then we're looking at more depreciation allocation and income shifting strategies to absorb all that depreciation up. So that's what getting you think of it when we same as a doctor, as what's the treatment plan. So you look at a patient and you say, okay, well, this is the stage that we're at, and so based on that, these are the strategies that would make most sense for this individual at this stage of their practice with these specific income numbers. And that's why you see the fact that estimated savings can be mirrored across all stages, depending on the strategies that they picked.
Yeah, and the beauty of it is no matter what your scenario is, there's ways to save taxes, right? So you're just kind of outlining the different ways depending on your situation. Um, Now going into some key takeaways, right? So again, the new tax law, it favors action takers who plan early. So you don't want to be a last minute kind of trying to get, especially with the real estate, right? Um, Bonus depreciation has increased, as I mentioned. It was at 40% and now it's at 100%, so a big increase. Take advantage of that now. Uh, Startups and acquisitions need cost allocation, right? So breaking down between the assets of whether it's the purchase or your build out cost, and using that for your bonus depreciation and maximizing that. Very important about the combination of strategies, right? So as we talked about, layering these tax deductions together to get to ultimately to the QBI deduction, which is a free deduction. So combining these things to get that massive tax win. And your CPA should be your advisor, not just a form filler. So they should be looking at your scenario, as Omar mentioned. What are your goals? What is your structure? Other things like that, and then advising on that stuff versus just filling out the tax return form. Maximizing these deductions through conversations throughout the year. Now, before we go into asking some question, letting you guys ask questions, Omar, did you want to add something?
Yeah, I had a takeaway on this. These are really important because think of it in this way: the fact that if you want to save taxes, but you're not going to not want to take any action, right? Which means the fact that, okay, I don't want to do, if you're not going to retirement plan, if you're not going to do property acquisitions, if you're not going to open a second location, if we're not going to do a lot of these things, then the amount of savings is going to be a lot less, because a law is built on action takers, right? And why is a law built on action takers? Because tax law incentivizes and rewards those that create business. If you're going and opening another location, if you're doing retirement plan, if you're doing those things, you are helping another business, right? Um, and that drives the economy. That's basically how it's built, right? So, and tax strategy isn't just buying a company vehicle. That's we hear that 25 times a month. That's not real tax rate. Is there some savings in there? Yes, may for the first year, and then they gets taken away again, right? But if your main tax strategy is I'm going to buy a company car, that's not really a tax strategy, because when you sell the company car, you're going to pay taxes, and then it all washes out, right? Strategy is taking a combination of various strategies to combine it together, like we said with combo strategies, to get massive wins. That is strategy. Stacking things on top of each other is strategy. Understanding what your goals are. I want to own multiple offices, or no, I don't want to own multiple offices. I just want to have one good office, work 3.5 days a week, take home X, and then let my money work for me by investing in things. Understanding your goals will tie to your tax strategies. But But you should expect to save taxes if you were to take actions. And it will often require you to either um, part ways with some cash, which means retirement, starting office, starting another business, buying equipment, something along the lines we discussed, right? Um, or it's gonna have you take a loan, right? If you're buying a bigger piece of equipment, you're gonna take a loan for it, right? So it's either way, the cash is going on the door, or you're taking on some debt. Those two things drive the economy, and those two things will drive tax reduction, and which is why you see people that have multiple offices or multiple businesses will typically pay at least amount of taxes, or multiple properties, right? That's how the tax law is written. But yeah, that's kind of my takeaway on this.
Absolutely. You guys can go ahead and start dropping your questions in the chat. But before we go to the Q&A, I want to just kind of, I hope everyone, enjoyed the webinar and found some helpful tips and learned some stuff. If you're an individual who wants a personalized tax strategy, I advise you guys go ahead and schedule a strategy call. We have only 15 spots left for this month. So I know those will go by fast. And so, from the things we talked about in the webinar, if you're someone who wants to take that action, I highly advise you go ahead and schedule that call, and we can look to apply those strategies for you before it gets too late in the year, and then it's kind of hard to apply anything. Um, so that being said, we can go ahead and kind of go through some of the questions. So let me go see kind of what has been said. And so the first question that we'll do is from Dr. Michael. Um, He wrote, as an existing practice owner, should I focus on short-term rental or purchasing office where I can be located? So I would say that it kind of depends on a couple of different scenarios, right? Of course, um, what's great about short-term rental and STR, right, is that sometimes people are just trying to get into the real estate game. So it's a good enterway, buying a single family home and using the short-term rental bonus depreciation to get that deduction and building your real estate portfolio. Obviously, the goal always is to own the place where your practice is located, but it might not always be feasible. If you're in a shopping strip, in a good shopping strip, a good area, it might be hard to buy that, right? And you don't want to move because you're in a good area. But if you might be in a standalone building, um, it doesn't hurt to inquire if the landlord is looking to sell, because that's obviously the goal is always to own the real estate. And with the bonus depreciation laws increasing, it could be very favorable. So that's kind of a scenario. It all depends on a little bit more factors than just saying yes or no. But I would look into those situations and obviously talk to a tax advisor and kind of see what's the best route to go.
Yeah, and people typically will use the short-term rental to get tax deductions the first year. And then maybe year number two or year number three, they convert from a short-term rental to a long-term rental. Sometimes they'll take those one or two homes they bought, and eventually, as there's some equities built over 5 years, go and sell those homes and then buy a small commercial building, something small, right? But that's kind of like the goal in real estate is to every 5 years flip, right? Take whatever you got and get your equity built, flip it, sell it for something bigger. And so when you sell it, if you do what's called a 1031, then you don't have to pay taxes on the gains, right? If you follow the specific rules of a 1031. As far as your practice location, if like we had a client whose landlord has let a shopping center just really, go downhill, right? And so they're looking to leave that shopping center, and they're running the numbers and they're saying, okay, well, if this is what I can afford, and if they buy a standalone building in that same area, then they're able to write off a lot more, and that write-off will pretty much pay for their down payment, right? But if you're in an area where the shopping center is good, you're getting steady flow, then it may not make sense to move out of that location. It just Even though no one likes paying rent for 15 years on a location.
Yeah, I think the biggest takeaway is just it's all about planning, right? And looking at the circumstances and making sure you make the right move and not just maybe chasing a tax deduction, right? You're looking at the overall picture. Um, Another question we got from Dr. Jennifer, what entity should I use if I'm starting a practice? So I think that's a very good question. I think we get this question a lot. So I think that's a very good question to ask. So both S corps and partnerships, they have their benefits, right? It depends on a couple of things like your ownership structure as well as your goal, your future goal. And so I would say that a partnership is valuable in the sense with basis. You're able to have more basis and not have to worry about that negative basis and kind of worrying about capital gains, like in the scenario we had talked about earlier. Whereas the S corp is very beneficial with self-employment tax and mitigating that amount. Now, obviously, with an S corp, you want to make sure you're profitable and you're going to be profitable because you don't want to be hit with double tax on distributions because you're taking money out to live your personal life, but you're in the negative, right? So I would say that they both have their benefits. You want to talk about your specific scenario with the tax advisor. And just like we were talking about the real estate, there's other factors that come into play, right? And you want to make sure you make the right decision by looking at overall things. But timing is also a very important thing as well. And even having maybe a combination strategy. So um, I'll give a couple more minutes here to see if anyone else has any questions. Um, but feel free to drop any questions in the chat and we'll be happy to answer them. So I'll give it a couple minutes here. All right, so it looks like I guess nobody has any questions. So we got we actually just got a question right now. So it's just asking how do we schedule a call? So you can go to our website right here, dentalcpausa.com, and there'll be a book a call link on there, and you'll be able to actually schedule a call as well. So we can drop you the link in the chat. We'll respond to your question, but you can just go to our website and book a call. That being said, then I think no other questions. So we hope you guys all enjoyed the webinar. Hopefully it was a learning experience for you guys. And we're excited for you to join us on our next webinar. So take care, everybody. Thank you for your time and hope you have a great rest of your day.
Thank you. Take care, guys.